Joining us now from the Atlanta Fed Conference to discuss all of this and so much more, David Zervos from Jefferies. David, it's always great to have you on. Whether it's those comments from Waller, whether it's what you are hearing from the flurry of Fed speakers that we know are coming from the conference you're at right now, sort of the key takeaway, what you make of some of these comments, because, I mean, we sort of knew hikes were off the table, but we also know the market's priced in fewer cuts starting later in the year.
That's right, Morgan. I think the Fed's gone out of its way to really cut that tail off to rate hikes. Jay did it in the press conference. We're now seeing Chris do it, and others are really pushing that way. So I think it's the mantra here, and what I hear everywhere is, look, we can just hang out a little bit longer at what we think is restrictive policy, and that should give it time to have some of those housing-related effects and other OER-related effects in the CPI take effect, and give them the direction for the CPI that they want. I think they were encouraged by the last inflation report, and he did. It's not an unequivocally bullish story. He's still saying several, which is probably 3 more inflation readings before he's comfortable. So, barring any major catastrophe on the labor side, I think the summer we kind of shut the door on the Fed, and we revisit it right around election time or after election time.
Okay.
Probably after election time.
So if this inflation cycle was in fact, we can say it was in fact triggered by supply shocks and not a reflection of a surge in demand, what does that mean for this disinflation narrative and this stickiness that's being debated around the so-called last mile to get down to 2%?
Well, I think it really just comes down to kind of almost splitting hairs, Morgan. We're not talking about 9% inflation like in the beginning of the summer of 2022. We're talking about 3.4 to 3.5 on CPI, 2.8 in PCE. These are numbers that are all within spitting distance of where we need to get to, and we've come a heck of a long way. I mean, this is something we should probably be celebrating. And I think the Fed did a little early celebrating in December. Both Chris Waller and Jay were probably a little too optimistic in terms of how they reflected their views. Maybe in retrospect, they should have been a little bit calmer, and they've had to temper those back a little bit this quarter. But they deserved a victory lap. I sort of give it to them. I think what they did was fine. The markets got a little ahead of themselves and had to back it up. But, I mean, at the end of the day, I'm still of the opinion that this has been managed extraordinarily well. I know that's not a common view. Lots of people get on here and like to talk about why the Fed failed and missed and was too late or did this wrong or did that wrong. The bottom line is this was the biggest inflation shock of most everybody's career that watches this show. And they came out of it with inflation expectations completely anchored in the long run. I mean, the break-even tells you that, the surveys tell you that, the curve tells you that.
Looks pretty good now, for sure. So Waller also said he expects continued high rates will continue to slowly grind down the economy, but not throw it off a cliff. And it feels fine if you own a bunch of stocks or if you own your home with a mortgage at around 3.5%. But the working class is hurting. So does this potentially at some point show up, these continued high rates, hurting that segment of the economy, and how will we know?
John, I think there's a lot of transfer going on here, transfer of wealth, transfer of benefit, and there's winners and losers when inflation spikes like this and when rates go up to fight that inflation. So you're going to have a lot of places where you can point to negatives. In our world, the institutional investing world, commercial real estate, they fed at the trough of zero rates. Unprofitable tech, they fed at the trough of zero rates. Private equity fed at the trough of zero rates. They're all in trouble. They've all been marked down. They all have problems. And there's parts of the weaker parts of the consumer sector. Yes, for sure. The inflation hits them harder. Their basket is more affected by this, but also their real wages have been up more. So there's at least a silver lining there. But against every one of those, there's a couple of positives that you can throw against it. Corporate pension plans are all basically solvent again after being insolvent. You've got insurance companies, endowments, everybody that had a long-term liability looking at that long-term liability and going, wow, it's a lot less than it used to be. I'm in a good place. So, and then you've got the boomers who are all sitting on 5% CDs going, this is pretty good compared to zero. So I don't think we can make a macro statement about the negatives here. I think overall, we get some aggregate demand slowing from these higher rates, but I think there's a lot of transfer, and that probably means there's a lot of sectoral work to do for people who want to pick winners and losers across various stocks as well as various sectors in the stock market.